and welcome to April's edition of SFI Not So Live with me, Jay Evans. Thank you for joining us and thank you for listening. We are a mortgage and property podcast based in the UK. We're recording on the 31st of March 2023, so just a bit of a caveat that if we do mention rates or certain types of criteria, we may be slightly out of date, so just bear that in mind if you're listening later date. Got a stellar panel for you once again. We'll be joined a bit late by one of our usual guests, but I have Mr. Phil Lawford from Saffron. Phil, welcome.
Thanks, Jay.
Introduction?
I'm Phil Lawford, National Account Manager for Saffron Building Society. I look after our intermediary relationships, and I've worked in the industry for 30 years now.
Fantastic. Welcome. And we've got Anna Sagar. Anna, hi. Welcome to the podcast again. You've been with us before. A little introduction for the audience, please.
Hiya, I am Anna. I am a reporter at Mortgage Solutions, an assistant editor for Specialist Lending Solutions. So I try and help cover everything mortgage industry, mortgage broker, anything that's helpful for brokers. We try and do our best to get the news out to you guys.
Great stuff. Thanks for joining us. And a new face, I say face every time, new voice, let's call it that, to the podcast. Richard, welcome. Quick introduction for the audience, please.
Thanks for having me. I'm Richard Merritt, Director of Strategic Relationships for SimplyBiz Mortgages. We are one of the largest mortgage clubs in the country. For my role, I look after all of our strategic relationships, look at future proposition, and probably relevant for today's discussion because I think we're going to touch on green. I also now chair the Mortgage Climate Action Group, of which we were a founding member.
Green is a very, very popular topic on this podcast. So, Richard, you're more than welcome to join us. Thank you very much, everybody. So let's crack on. I've already caveated, but we just talk about some of the biggest stories that are affecting the mortgage industry and the property market in the UK. Some of those are slightly wider and outside our market, but might influence it. But as I say, this is currently the 31st of March 2023. So without further ado, let's crack on. Our first story comes from Mortgage Solutions, and it's an opinion piece by, what do you know, it's for Anna, and it's regarding the mini budget. We're 6 months on, are we over it, is the title of the article. So, Anna, I'm going to come to you first because you put it together. This is a comment piece. There's a lot of industry voices in here talking about where we are now compared to where we were when it kicked us in the guts a little bit 6 months ago. What did you hear from the people you were speaking to? What was the sort of common themes that people said?
So I think the common themes were that pricing is starting to come down. Obviously, after the mini budget, there were lots of product withdrawals and repricing. So the general points was that most of the products have come back. Pricing is starting to come down a bit, but it's a tale of two different markets with residential and buy-to-let. So residential is coming down a bit more. Buy-to-let is still not coming down as quickly, and so then there's more. In order to get the lower pricing, buy-to-let deals will have higher product fees, and the affordability is still a bit of a struggle. And the general kind of consensus I got from people was the kind of sub 1%, 2% mortgage is just not going to come back. 4% is probably going to be the norm. So I'd say those are probably the key takeaways from when I spoke to people.
So there's been a fundamental shift in people's opinions. They think those 1 to 2% are gone.
Yeah, I think they were just kind of like, that was kind of a fluke anyway, because swap rates got to such a low point, whereas swap rates now are, I think I checked just before I came on here that the latest 2-year swap is about 4.25%, and then the 5-year is about 3.78. So they think it's probably not going to get down to the kind of heady lows that we've seen previously.
Great, Phil. You've had a chance to review the article. What did you take from the comments, and what did you agree with?
Yeah, I thought David Hollingsworth had probably got it banged on. That I think the biggest casualty of the debacle in the autumn was confidence and consumer confidence. That's going to take the longest to recover. Interest rates. My view were interest rates were always going to go up. That was happening anyway. That was the direction of travel. But the consequence of not consulting properly, it being really ill thought out and executed, was that Everything happened a lot quicker and more unexpected than what should have happened. So that and that's what I think that's the biggest thing we've obviously got to grapple with. And then obviously the second point is landlords are feeling it probably more than most. I know we're going to talk a bit more about landlords, but landlords are being hit on several fronts at the moment. So it's not just interest rates as well. There's other factors in play, but obviously higher rates means interest rate coverage ratios where the rent covers the mortgage payments. That's not working at the moment. And so as it nailed there, we are seeing more higher fees, and that's been called out quite a lot. But I suppose what's the alternative? Top slicing might work on some occasions, but it's not going to work for every scenario. So at least some higher fee products does create more choice in the market, but whether it's the right answer, I don't know.
Richard, I'm going to come to you. Let everyone have a comment on the article. I've got a couple of questions for you all in a second, but your thoughts?
Yeah, I agree with Phil. I think the main point that I took from it was the dent to consumer confidence. If you look at where we are today, we were on an upward trend for rates rising before Liz Truss and Co.'s intervention. That obviously kicked it on a touch further and fairly rapidly as well. But if you fast forward to today, we're starting to see a bit more stability in rate. We've actually seen some innovation from lenders, little movements on proposition, on criteria. And I think although everyone expects the market to be quieter this year, the outlook today is probably back in line with what we thought 2023 might look like before the mini budget dented everything. We were always expecting a quieter year in 2023 compared to the record years that we've had 2021 and 2022. That said, I think the longer term impact, and I think this word was used in the article, is psychological. This was pain that we as a nation, obviously not us as individuals, we weren't there making this ridiculous call, but it was pain that we as a nation have inflicted upon ourselves, much like Brexit, unfortunately. So I think whilst we're starting to see a lot more stability and more prudent fiscal policy coming out of today's government, I think that dent to consumer confidence, that dent to trust in the people who make these decisions will probably be far-reaching for many, many years beyond this, even long past the economic impacts.
I have to agree. That was very concise. Thanks, Richard. There's a second part to this particular part of the podcast. We're going to move on to the recent budget in 2023. And actually, this one took my interest. It's from Rosie, Financial Reporter, looking at the missed opportunities of the new budget. We're talking about the impact we had from the car crash of a mini budget. Now we've got a budget coming forward, and did the Chancellor really take advantage of that opportunity to help our market? And Anna, let's come to you from a journalist perspective. Did he miss an opportunity? Were there opportunities for some reform, some opportunities to look after first-time buyers need some help, don't they? There was opportunities there, but did he really take any?
I think there were probably a few things that he could have done, but equally I remember before the autumn statement, when I kind of talked to brokers before the autumn statement, the kind of resounding thing I heard from brokers was like, please leave the mortgage market alone. Just leave it. Stop messing with it. So I think maybe he thinks the housing market, he's just kind of like, actually, maybe that deserves a bit more thought. But again, I'm not in the Treasury, so I don't know. But I think there was definitely some things around first-time buyers, stamp duty reform, possibly some stuff on downsizing that he could have possibly looked at, but I think he had in his mind he had a lot more bigger fish to fry, even though housing is very important. But yeah, that was his decision that he took. I don't think people in the mortgage industry would have done the same thing, to be honest, but that's just my take. So,
Phil, what do you think?
I'm not. I think I'm not. I wasn't surprised that nothing was done. Yeah, there's opportunities missed, but as I've been honest, we're in that cycle where there's going to be an election next year, so maybe they're waiting for the bigger stuff closer to election time, because anything good now will be forgotten next year. So that's the cynic in me, or that's really what I think. I just hope the two main parties are brave when they do make some big decisions. Because of that was slightly off topic. We're in a housing crisis in this country. We need fundamental, brave and ambitious long-term plans, more than a cycle of Parliament would cater for. And housing stock is I think we talk about it on most of these podcasts, but housing stock is just that needs to increase, and it needs to increase for starters, first-time buyers, for families, and also socially as well. We need more social housing. So all of that, we need a big plan. And we need to do it in an environmentally accountable way as well. So it's joining all of that together, really, and that needs a big, ambitious plan. So I really hope the two main parties, will address it next year. But yeah, there's been a lot of missed opportunities, but I wasn't surprised.
There's been some whispers. I have heard a Labour MP yesterday saying there were some whispers of social housing reform and various different things and house building targets. But Rich, we'll come on to that in a bit, actually. I want to talk about something else. But Richard, just on this subject, and I'm going to chuck a couple of questions your way.
Yeah, sure. So, first and foremost, to Phil's point about an upcoming election next year, I'm not sure what they can pull out of the bag other than a miracle to save themselves at the moment. But coming back to the points we've just discussed on consumer confidence and trust, I wholeheartely agree with you, though, Phil. Opportunity missed in terms of the building of more homes. We've had a stated pledge to hit 300,000 new homes per year for some considerable time now, and we're falling well short all the time. And I saw that Richard Fearon of Leeds Building Society was quoted in the article. He gave a fantastic speech, including personal story about home ownership at the recent UK Finance lunch, and he was absolutely on the money. Until we start building more homes, this is going to be a problem that continues. We can do a variety of things around stamp duty, affordability, all sorts, but the fact of the matter is we are not building enough homes, and while we're not doing that, we're going to struggle to support the first-time buyers and potentially even, as we move further in, the private rented sector.
Well, even with that house building target, the government has kind of said that it's actually, no, we're going to make it voluntary. So even the target that they've never met, they've actually just said, oh yeah, we'll just, it's not a hard and fast target now. So it is basically like they're grading their own homework. And so I'm just like, well, you weren't building enough houses anyway, and now you're definitely not going to. And it's also, you have the supply chain issues with builders anyway. So it's not that builders don't want to build houses, but they, the material costs and the supply chain issues are really grave. And then I think there was also the one thing about housing that they did mention in the budget was about nutrient neutrality. So they said, so new developments have to not be as polluting, basically, is the crux of it. But because of that new regulation, 74 local authorities in the UK can't build houses, or there's loads of delays to the houses that they were already building. So, and the government said we're going to launch a review into it, or we're looking into it. So that was the only real bit of housing stuff in the budget. But even then, they didn't really say, oh yes, we want to build more houses. It's more, oh yeah, there are problems, and we'll just try and find a solution to them. It's not actually innovative thinking.
We are in we're in a horrible political phase of let's just wait for the problems to get disasters before we actually do anything about them, and then we can't fix them at all. But that's interesting. Going on your cynical point, Phil, it'd be interesting to hear from the rest of you about there being an election coming up and this all being a bit political. Do you not think that there is a missed opportunity in local? Bearing in mind local elections are months. I know they can't make any difference, but I thought if they were doing this politically, they would have looked at the local areas and local elections and gone, actually, we need to appeal to these people because there is a particular housing crisis in their local area. It seemed so. Maybe, Phil, I'm agreeing with you that there might be something impactful that comes up a bit closer to the election, but I don't know about you guys. We're all intelligent people. We know that nothing's really going to make any difference when you hit the election. You've got 2 years before you see any kind of policy really taking shape. So do you think they've left it too late?
I think that's a very, yeah, sorry. It's a very, I don't know. I feel like they may have left it too late. I know that in the budget they created in 12 investment zones. So I don't know if that's kind of a way for them to kind of say, oh, look, we're acting locally and look at us, we're doing, we're going to areas that have been underinvested in, and aren't we brilliant to kind of address that local point. But I do think that, I can't remember if it was on the radio or but a lot of seats that voted Tory and that changed to Tory in the last election are now switching back because they actually said that, because the general view is, well, you said you would do all of this and you haven't. So, I think maybe they have left it a bit too late, and I think they might be, trying to, as someone who's kind of writing about government stuff, it seems like every other week or even multiple times a week there's some kind of announcement coming through, so it does kind of feel like they're just being like, look, we're doing things, we're doing all of this stuff. Isn't that fantastic?
I think the dangerous point for them is they say they're going to do it and then someone disproves it literally the next day. It was like the barges story on the front page of the Sun. I mean, that was gone and disrupted, completely ridiculously kiboshed the next day. Richard, you look like you were about to say something. There look like you have something to say.
Yeah, sure. And Anna touched on it earlier with some of the brokers that she spoke to pre-autumn statement. I'm in the camp that no government intervention was a good thing. We had this back with the stamp duty holiday when post-COVID the market started to pick up, and whilst everyone has benefited from the stamp duty holiday, people buying home, well, maybe not removal men and conveyancers who are probably now seeking counselling to deal with the volumes that they dealt with. Lenders, intermediaries, we all sort of filled our boots, so to speak, off the back of that. But I think for a lot of people, they actually felt that it wasn't needed, and it was it was seen as a good thing for the market. But if you fast forward to some of the things that we will talk about later on house prices, had a real knock on what I guess would be perceived as a positive impact for house prices. I'm not sure everyone buying a house in the last 2 years would agree that it was a positive impact, because it created a bit of furore and a bit of rush, and it was a shot in the arm that I don't think we actually needed. So if you look at the budget, I think the fact that there was no government intervention is actually a good thing. And for me, if there was anything that they were going to focus on, I would have liked to have seen it.
No, I think we've lost it. Richard, we've lost the signal a little bit, I think.
Sorry, I do apologise. Am I back at all now? Or,
yeah, sort of. The funny thing is, it's recording on your computer, so I'm actually getting the audio. So hopefully you managed to finish what you're saying before I interrupted you, because it's actually recording it. But
okay, so
see if you're back.
I rewind a step then, because I'm assuming you'll be able to edit it. Am I back again? Still, it's still recording on my computer. So what was quite interesting.
Just Richard, we'll wait for you for a second. Just see if you've got anything open that might be disrupting your signal, and then we'll just sit and wait for you for a sec.
Right. Shouldn't be.
There we go.
Everything else
you're back.
down.
You're back.
Yeah, I'm back. Okay.
You're back. You're back with us. You're back in the room. Right. Don't worry, I can do some creative editing on that.
I'll rewind a quick step then. So, I think if there was an opportunity missed within the budget, then this was touched on in the article. But I think things that encourage more older borrowers to right size, to consider selling their property, which will then impact some of the stock, so that it doesn't all have to be about building. We are a small island, we've got a finite amount of space, and we're eroding all the green areas more rapidly than I care to see, that's for sure. So I think if we can encourage the sort of reusage and repurposing of existing stock, whether that be older borrowers selling properties or commercial premises, retail premises, making it easier for them to be converted to new homes, then that would be another answer. And then the other one for me, I've just said, we didn't need the stamp duty intervention. But where I would like to see stamp duty used is to support the green agenda. And I know we're going to be talking about that later, sir. But what I would love to see is green incentives around for people who buy homes and then go on to retrofit them, potentially getting a rebate on stamp duty, which encourages people to actually go out and spend money to improve their home, improve the energy efficiency of it, potentially save money on bills, but they then have an incentive to do so.
Great stuff. Thanks, guys. Moving on to a story in the Mortgage Strategy on the Mortgage Strategy website from Linda. Speculation mounts over new EPC deadline for landlords. This could be a wider discussion. Richard will be very pleased for that. It's going to be a wider discussion. But this has been something that landlords are under a lot of pressure already. There's a lot going on for them. And I think the government have perhaps wised up a little bit and thought, let's give them a little bit of a break and let's push this back a bit. So basically, speculation saying that it could be pushed back, the deadline pushed back till 2028. So wider discussion about EPC ratings. I just want a really quick from each of you, your thoughts on whether you feel this is the right approach to looking at the quality of our houses. Richard, bearing in mind your experience, come to you first on that. What's your opinions on EPC ratings and what can we do better?
Well, look, we have to do something because the sustainability and climate change point is not going to go away. We have a pledge to get to carbon neutrality and net zero as a country by 2050. EPC ratings are not about getting to a carbon neutral point. They are simply the energy efficiency of a home. But equally, we have to have a measure, we have to have a vehicle. So it's the best thing that we've got at the moment. I think from the legislative point on the dates, I'm disappointed to see them move because it's almost a sign to sort of say, does this matter as much as we need it to? But equally, we did need to do something that wasn't quite so draconian as to say, landlords, you can only rent a property out if it's C-rated or above in 2 years, because it was going to be impossible to hit. So I think what we really need to see is greater education around what needs to happen, greater incentivization for people to make those changes to their homes or the properties that they rent out, and above all, greater government intervention and a more joined up policy to help everybody reach this aim together, because it's something that will benefit all of us.
On that same subject, Anna, your thoughts on EPC ratings or around the room? Anna, your thoughts on them, and we'll touch on the actual story in a minute, but just on EPC ratings generally.
Yeah, I mean, I agree with Richard that it's not a perfect system, but it's one of the only systems that we have. I think it's better to kind of tweak the system we currently have rather than just throw the baby out with the bathwater and bring in something completely different. There is a story that my colleague Shakina wrote actually about talking to surveyors about what they would do with EPC ratings, and they were saying, well, actually, it needs to, rather than it being an estimate of energy efficiency of a house, it actually needs to look at people's actual usage. So that would be a possible tweak, and kind of like actually, the estimate could be you use. An average person would do this, but some people, you might have like 4 or 5 people in a house. It might be a student house, or it might be actually only 2 people live here, and all that. I think actually incorporating new nuance would probably be would be a good tweak to make, I think. But again, that would be very complicated. But I think it would be that. I think it could be, help people understand where they can improve and where they can be more environmentally friendly and energy efficient.
Phil, I think we'll all agree with both Anna and Richard on what they said is all we've got. But do you think there's enough consumer understanding of what it means? I'll give you an example. My little sister, she's 40. Call her little sister. My little sister thought her EPC rating was just a sticker that was on the side of her fridge. When she bought it, they told her the rating of her fridge. That's how she saw it. She didn't really there's no nuanced education there. She's going to kill me if she listens to this. How do you think that consumers need a bit more information, need a bit more guidance and a bit of understanding of it?
Yeah, absolutely. I think you've hit the nail on the head. We talk about it a lot now in our industry, but it's all about education, and it's not translated out to consumers anywhere near enough. But I agree with Anna and Richard's comments that in terms of EPCs, it is all we've got. I think the biggest problem is that, particularly for landlords, is that a third of, I think it was estimated, something like a third of UK landlords have pre-1940 properties. So it's a massive problem for landlords to get it where it needs to be. So being pragmatic, back to the story, I don't think there was a lot we could have done. So it at least gives them some time, and hopefully can use that time to educate the wider public about EPCs and the importance. I think the other bit, and also mentioned surveyors. I think what we haven't yet seen, and I'm really interested in this point, is when are we going to see improved EPC ratings of a property translate into the property of the value of people's property increase? Because there doesn't seem to be a correlation yet, and I think once people see, actually, I've improved my EPC rating, hopefully it means their bills will go down and improve them in the pound in the pocket, but also actually I've got a much more resaleable asset in my property, and we haven't seen that yet, and I think it will translate eventually, but until we get that to that tipping point, that's always going to be a problem as well, because if your property's worth more for doing that, that's tangible then, isn't it? And we're not seeing that yet, but we need to see it. So do we need to engage with surveyors more, or is it just the market sentiment thing? I don't know.
Just for the audience benefit, we've been joined by Tony Hall, Head of Business Development at Saffron. Welcome, good afternoon, Tony.
I think I've seen Noah on my travels, because it is so wet out there, the number of floods I've been through. So apologies for being late, but I thought safety over speed was sensible.
I'm glad you took that. Well, we're talking about EPC ratings, and actually, your timing's impeccable, because we were at an event together last Wednesday, and a lovely lady in the audience asked a really interesting question that literally took me by real surprise. So your timing is impeccable. Just tell me a little bit about what you were talking about on your event, and then maybe just bring in what the young lady said, which I thought was inspired.
It was genius, and it was the genius of someone on the periphery of our market, and therefore not jaundiced by opinion already. So I was on a green panel debate at the Future Financial conference, and discussing all things EPC. And I was listening quietly to you guys a minute ago talking about it, and Phil's right. The sea change is the what's in it for me. Once a consumer understands what's in it for me, they'll start to do something. So if you understand the impact of the value in your house, then I think that's right. I think some of the things we discussed, though, is some properties it's just not possible to EPC them or green them. You know, one of the panelists is Roger Morris, who's obviously a well-known figure in our industry, but he's a portfolio landlord of some 30 odd years, so he's seen all of this, and he talked long and hard about lots of things. But he talked about Victorian properties, where if you actually improve the EPC rating on them, it creates a bigger problem, because those houses are meant to breathe. So if you do them with nice windows and all, energy efficiency, they start to get damp and mold and create broader problems. So actually, some properties aren't actually there. And when I say some, probably 2/3 of the housing stock in the UK is probably in that ilk. So it's a challenge. But one of the things that we talked about was, actually, if the house can't be made energy efficient or EPCable, what about what they use to heat their house? So if the energy is coming in from a renewable source, can that go towards the EPC rating of that property. So it's not something that they can control through a choice. So I think that was useful. But going on to the question that Jay raised, a lovely she's a freelance writer called Hannah Duncan, and I'm arranging to speak to her in the next few days, because she asked, we're all thinking about what we can do inside the house to make it more energy efficient. What about your garden? What about planting trees or wildflowers? How can we utilize that to offset a house's EPC? And I just thought it's got some flaws from a lending perspective, because you can kind of grow a tree and then cut it down, or the next person cuts it down. But I just thought it's genius thinking outside the box. I noticed Richard had his hand, so
yeah, I like that's what I liked about it. She really just sat there and thought, hang on a minute, just think differently, do something differently.
It was a wonder. It was a real epiphany for me to go, do you know what, that is somebody not in our industry every day asking a really sensible question that all of us just went, do you know, that's really good.
The room literally went at her. It was just bizarre. It was a moment, I think. It was one of those moments. I'd only been in the room about 2 minutes. I just finished my panel. Sorry, Richard, we carried on the conversation, but you were waving away, so you've got something to say?
No, not at all. I couldn't agree more. And I've actually spoken to lenders in my capacity about this. And yes, we can focus on the house. And we can get people to make their house more energy efficient, but what we need to be focusing on is the household. So interesting that she took the angle of the garden, but it comes back to the point that Phil touched on earlier, the education and the awareness, and if we can actually encourage, use the corporate know-how, the ESG understanding, the sustainability understanding that lenders and big corporate businesses will have access to, that consumers and even mortgage intermediaries will not, if we can distill that and get that out into the public sphere so that they understand about the little changes that they can make to shift the dial on things, changes in their own energy consumption, changes in their own plastic wastage, all of that sort of stuff. That is the where we should be focusing for me. I said it slightly tongue-in-cheek to one lender who was saying, we want to offer green mortgages, and they were going to talking about doing something that rewarded someone who's got something that's already A to C rated. Well done, you're rewarding someone who's buying a new build. I actually said, you know what, you'd be better off giving out free or tokens for LED light bulbs, or who gives a crap toilet paper, and actually reinforcing people to go out and use more sustainable materials and ways of living and working.
I'm so glad you said that, because you get me a chance to have a little plug. Coming up in May 2023 will be young Richard himself and a few of us on the panel. There'll be a webinar on green finance where we're going to delve into all that in much more detail. So thanks for that, Richard. You set me up a nice little plug. Anna, you look like you were going to say something there.
Yeah, I mean, it's something I hear from brokers a lot. Is when I've asked about green mortgages, they say, well, it's rewarding properties that are already there. And actually, kind of what would be better is like further advanced kind of deals, or maybe something that could encourage people to make the improvements. And something I saw that was really good from Halifax is they teamed up with the Energy Savings Trust, so you can put in your postcode and other details of your property, and it will kind of roughly say, okay, so we think, obviously because it's from databases and things like that, we think your EPC rating's this. This is where we think you could probably get to. This is how much it's going to cost you. This is how much you'd save on your bills. And I think that was a really useful tool to kind of just help people visualize, okay, what are the easy wins that I can do? What are some of the longer term things that I could do? What's achievable? So I put my house in, which is like a Victorian terrace. So, there's a lot of things like getting the roof done, which I'm just like, well, I can't, that's a bit of a longer term project that I probably am not going to do. But things like, I know that we said Victorian properties shouldn't have double glazing, but it's things like, okay, maybe some window, you can put double glazing in, or you can do other things that are a bit easier. So
To that point, Anna, though, we've got 5 of us on here. Who's got a sofa in front of a radiator or a bed in front of a radiator in at least one room in their house? Yeah,
I'm lucky I don't, but yeah, a lot of people do, don't they?
Just actual repositioning of the furniture in the house to ensure that what is heating the room has can expose itself to the whole of the room. Fabric first approach, draft excluders. Draft excluders are a very 70s, 80s thing. I'm sure you can get really nice ones on Etsy nowadays.
Do you know what? There's actually in videos on YouTube on how to make them out of dry pasta and various other things. Absolutely brilliant tips, honestly. Just to geek out a little bit, when and actually I'm going to plug Saffron, but inadvertently, when they launched their retrofit green mortgage, I did some research on this. I did exactly that, Anna, as you were saying. I went out and just looked and tried to find out what we could do, small value things we could do to get that rating up for an F to an E, and it was quite simplistic stuff. It wasn't like, go and double glaze your whole house. It wasn't that. It was a couple more inches of insulation, or which was probably the biggest expense of all of them. But some of it was like, if you haven't got double glazed windows, the sheeting that you put on the inside. The people have made some really clever stretch versions of this that you can attach to without even damaging your walls. It was just the things I found, and the innovations are there. I think it's education now. It's education.
Turning your computer off instead of leaving it on standby makes a massive difference. It's all the little things that will mount up, and I think you're absolutely right, Jay. It comes down to education and making more people aware of it. And I do. Whilst the cost of living crisis is a horrible thing, and clearly lots of people are being affected by it, I think that will actually be the tipping point, because people are going to start to feel it in their energy bills, and this is where advisors getting behind it and embracing it. When you're looking at customers' costs, if you have a basic awareness of how people can make their homes more sustainable, you can actually help people. But you don't have to go out and spend 15 grand on a heat pump. I mean, if you've got the money and you want to do that, great. But if advisors can actually just sort of have the curiosity to come out and explore some of the options that are available to people, and just be able to offer little bits of advice. They'll do it on their mortgages all the time. I'm sure there's lots of great advisors out there advising people who are on a 1 or a 2% rate to overpay at the moment and prepare themselves for the rate jump when it comes. They can do the same by embracing the green side of things and help them save their money on their bills.
Yeah, I think also brokers can just signpost to a lot of resources as well. So even if it's just like, look, I don't know, this isn't an area that I have a huge amount of expertise on, but look at the Green Finance Institute, look at these guys, and maybe even if you're not providing people with a drop down list of like, do all of these things, just being like, hey, these are useful resources for you, because then that's also a very valuable thing, I think.
There was some lovely. Sorry.
I was just going to say that Anna touched on the Green Finance Institute, the handbook that's been produced, and the AMI website that's been produced in conjunction with Mortgage Climate Action Group. They're great resources. I would urge everyone to go out and have a look.
When we post the podcast, in the comments, I'll put some links to those in for anyone listening. I'll put some links in. Richard, if you've got any links you want to send them over, and I'll put them in the description. Sorry, Anna, I talked over you.
No, I was just going to say, we, on the Mortgage Solutions editorial desk, we just have it as pinned, just in case, if we need to talk about green finance things, or, we just have it as a little editorial resource, so it's very useful.
I have to say, to be fair to lenders, I was with about 6 building societies on Wednesday, and the resources they've got for brokers now, which I didn't know about because I'm not a broker, obviously, but I had never seen these resources before, and they were showing me around some of the platforms, and there was some brilliant videos and tips, and actually there was, some of the lenders have really good tips on there on this very subject. So there is a lot of work being done. I know Saffron's doing the same. There's a lot of work being done in the background, which is really good to see. We could talk about this all afternoon. We'll be here till Saturday morning at this rate. Oh, sorry, but one more comment from Tony as he's just around.
No, it's a practical thing again. Going back to Richard's point around you can do something. It doesn't always have to be the grand gesture. So this is again something that Roger mentioned on Wednesday, that thermal curtains cost £96 and will save you roughly about £350 a year on your heating, which is the equivalent saving of a heat pump. Okay,
that's crazy.
So it's not about doing the expensive stuff. It's about doing the power of marginal gains and doing these small things as and when you can that will really add up. So it doesn't have to be this daunting outlay. So I just thought I'd end on that because it's a really practical idea.
Well nuanced actually, because Richard, you mentioned about the heat pump, and that was the first thing that popped in my head was I bet they did nothing before they got the heat pump. They just had the cash in the bank when I get a heat pump. Hang on, yeah, I'm going to save some money on my bills. They didn't actually look at the house as a whole and say, what can I do to make that heat pump even more efficient for me if I actually don't, have leakage. As I say, we could talk forever, but let's move on. Due to time constraints, we're going to jump over to we're going to skip the bank story for just a second and move over to the BBC News story, which says mortgage lending hits lowest level since 2016, excluding the pandemic, of course. Here comes your crystal ball moments of what's going on here. But, we're all a little bit surprised. We mentioned a little bit earlier, actually, that the property market really did kind of keep the economy going during the pandemic, which was never what everybody thought it would do. And we ended up quite buoyant. But this is now talking about lending in general fell. We're in a cost of living crisis, so it's part of that sinking in. But what were your thoughts on this? I'm going to let's go to Tony first, because you haven't had much chance to talk, Tony. Have you had a chance to review this one?
Yeah, it's odd because isn't there another article that says mortgage lending has rapidly gone back up the next month? So, I'm not quite sure which lens we should be looking at. It has dipped. It's been, we're speaking, Rich is in a much better place to confirm this, but Phil and I speak to our distributors all the time, and, their summary has been, this year has been heavy on completions so far as the pipelines go out, but new business is quite slow, as much as 30% down in some cases. So this is no surprise that, cost of living for one, the cost hitting on affordability, plus the rising interest rates, it's a bit of a no surprise story, really, in my honest view. But it also is what the market does.
I was going to say you're always going to get it, aren't you?
Any year and any month, we'll have an article like this that kind of mirrors it, in my view.
The reason I put the story in, and Richard, you can maybe help me out a little bit on this one. The reason I put the story in is a little bit what Tony just said, actually. We had a huge backlog. A lot of lenders had a lot of mortgages going through. So actually, we're getting more completions, but actually new business is slowing. It was the way I saw it. Do you agree with what Tony said?
So I do, yeah. I think there's a couple of other points to make, though. So one, you've got we're in a very refinance heavy market right now. And you've obviously got a cycle of cessations, this is reporting on February data. February is the shortest month in the year. I don't think I ever remember in the recent history seeing a product that ended on the 28th of February. So there's naturally going to have been less remortgages that complete at the end of February than there will have been at the end of January, because that's a big cessation point. I think to the application data, what we also know is that we're in a very PT heavy market right now, product transfer heavy market, for anyone listening who doesn't know what a PT is. Those applications don't get reported on in the figures. So we'll see a lot of that information at the end. And from a distribution perspective, we see product transfer data reported in completions, but we don't see it reported in applications. So there have been certain points since the mini budget where the level or the volume of product transfers has really shot up, where we've been like, oh, this is a little bit worse than we're hearing anecdotally. Because if you go out and you speak to brokers, a lot of them are doing a lot of product transfers. So I think a lot of this will be in the data that we're not seeing. I think the other final point to make is if you look at where rates have been since Christmas, we spent most of January basically just sort of going, it's going to get better, it's going to get better. So the advice to customers from intermediaries who do a wonderful, wonderful job, is a really key point to make here. A lot of intermediaries were really, really busy in January, having great conversations with people and just saying to them, hold. And what we've then seen is a little bit more activity in late February and certainly across March. What's going to happen with interest rates has been like the hokey cokey over the last few weeks. Are they going to go up? Are they going to go down? Something happens. Oh, they've changed their mind. So I think that will have really sort of affected the volume of applications that are being done as people sit and wait. What it does really, really emphasise, though, is how important a broker is. And I know I've spoken to a lot of brokers who have said recently, we've got lots of customers doing product transfers, and they don't want to send in one bank statement or one payslip so we can do it. Every case should be advised, because what a broker is going to do, they are going to sit and monitor that, and if things improve, they'll be straight on the phone to the customer and advising them, actually, you might want to change this. If they get worse, they'll secure it for someone. So, I think really, really key point to make on the importance of advice while all of this is going on.
I think that's true, and I think if they're not getting the advice, Anna, from a broker, and you're looking at an individual going to a mortgage from their bank, they're not going to get the same advice, but actually they are more likely to just sit and wait, as Richard says, sit and wait and see what the market's doing, aren't they?
Yeah, I think, I totally agree with Richard that a lot of brokers I'm speaking to, they're having lots of conversations with their customers, but the customers are taking a wait and see approach, because a lot of people just expect rates to keep to kind of, they've been going down quite kind of steadily, from someone who has to writes a lot of lender update stories. It's usually like 3 or 4 lenders a day are kind of tweaking their rates. Like some are increasing them, like tracker rates. Obviously, when the Bank of England increase the base rate, they'll go up. But the majority of rate changes we're seeing are decreases. So it makes sense to hold off. It was interesting thing last week was some of the big banks like Barclays and NatWest and I think it was HSBC and Nationwide, they kind of reported their, how many people remortgage with you, how many customers stay with you, and I think it's roughly about 3/4. So I think that's a bit, that's quite interesting that maybe 3/4 of these big banks, 3/4 of their customers might not be getting broker advice if they're just going straight through to a product transfer. So I think that's quite interesting, but just a point to think about, that actually a lot of people might just do a PT and not be getting that, they'll just take the easy option rather than maybe kind of just going to a broker and seeing what their wider options are.
That stems to a wider point, really. We were talking about education a little while ago. I think there's a lot of education needed early doors for first-time buyers, I think, as well, to actually know what the point of a broker is and all the benefits of a broker, because frankly, I talked to my sister earlier. She's going to kill me. I sent her to a broker in the end, and said, "Look, go to a broker. They'll find you a product, because one's self-employed, one employed." It was all complicated, but Phil, that's really our mission now. And I know you guys at Saffron are really strong on educating brokers, but it's the consumers need educating about brokers, really, isn't it?
Yeah, absolutely. I mean, we talk about this subject a lot. Is at the moment there's a lack of education in schools on financial services and how to handle finances. That's there are the good news. There are a lot of initiatives coming in now, but in the meantime, there's still this gap. So how do we fill that? So Richard's point was, I couldn't have made it any better. Is go and see a good broker, because of that. That's the best. That's the best route to it.
I think the point here is things change and they move so quickly. And I know we've sort of skipped the Silicon Valley and Credit Suisse bank story. But if you look at what happened and the outlook for what was going to happen with interest rates, just in a heartbeat around that, it's really, really important to have someone who is going to access that information. I wouldn't expect a single broker to be able to predict what is going to happen in the world, because let's face it, it's impossible. Predicting things is a mug's game right now. But to be able to give a balanced view about what's going on, and and Anna, you said hold up. I'd actually fundamentally disagree with that. I would say the right thing to do today is to secure something, but provided you can unpick it afterwards. And that is where a broker is going to be able to add value. Because if a customer secures something today, if it gets worse, which it might, they've got that rate secured. If it gets better, which it might, then they've got the option to unpick.
That's what. Let me clarify, because when they say hold off, it's more like, oh, we'll get your foot in the door with your current lender, but we'll just, don't necessarily commit right away. Don't kind of go for the first person who asks you to dance kind of thing. We've
gone from a really benign advice environment where it was so easy just to say take a 5-year fixed rate, because there's 5-year rates at 1% and 2%, and now it's not cut and dried for anyone, and I think everyone is probably umming and ahhing. Would you fix for 5 years at 4%, or fix for 2 years at 4.3, 4.4, and take your chances that rates might come down? Who knows?
Jill, one of my favourite phrases to use in this podcast is "pull out your crystal ball," because it is literally that, isn't it? You can. We've had a seriously good economist on here going, "Don't make predictions; not worth it," which is very true. But the next story, which I'll only just touch on, because I want to go back to the Silicon Bank thing. So I want to talk about the nuances of what that means for our market and how that's going to affect. Because Annie, you had some really good say a little while ago about that. But just onto the last story, really, really quickly, because this relates a little bit to what we've been talking about, and you have just mentioned it a little bit, but the approvals are up now. Mortgage approvals seen, and actually the shortest month, as Richard just said, February, actually saw an increase on January. So we are seeing people getting approved. Tony, is this because criteria is being adapted to allow people more chance of affordability? What do you think it is? Do you think it's the market adapting to our scenario and our situation, and so they're able to get more approvals through?
Yeah, look, it's an amalgam of what Richard and Anna have both said already. Really, February's a short month. A lot of maturities probably in March, so a lot of product transfers, a lot of remortgages, and rates did drop in the month. So we saw a load of sub 4% rates. So a lot of people would have snapped those up in that period. So I think it's just that affordability models aren't going to get any cheaper. In fact, they're going up even more, quite frankly. Ours has recently, because we've had to add, we have to pass on the appropriate cost to making a responsible lending decision. It's not getting any cheaper, and I haven't seen any drastic changes in like adverse credit policies from lenders or anything like that that's going to help those that can't lend. But I think it's just an amalgam of all the things that we talked about before, personally.
I think that's why I would skim this, because it just seems like we've already talked about this subject already. Phil, anything to add before I move on to the other two?
No, not really. I don't think I could add any more than what's already been said, to be honest.
Tell you what, then we'll go back to, and thanks Richard for chucking it in, because I was going to go back to it. I wanted to skip it because it's make it the last one, because it's quite a meaty one, this one, and what we can talk about. So we've seen the collapse of Silicon Valley Bank, we've seen the sale of Credit Suisse, the collapse and sale, should we say, really, because they were on the way out. It does have an effect on our market. It might not be direct, but a lot of it's on confidence. There's a lot of shifting. And we had a lovely chat just before we went live, so perhaps you could just relay what you said to me on your research for your article, and the fact you had to rewrite it. I think that was really key. That's a really key point there.
I think it kind of feeds into what Richard said, is that it's so hard to predict. It's impossible to predict what's going to happen, because immediately, so the timeline of it was Silicon Valley Bank collapsed, and then there were there's First Republic and another one I think one of them collapsed and one of them was propped up by the US government.
Bank, I think was the other one, wasn't it?
And so immediately after that, swap rates in the UK started to fall, because people thought that the Bank of England would keep the base rate, they wouldn't increase it. And so then I wrote a story basically being like, oh, this could, this looks scary, but it could actually be better for mortgage borrowers because mortgage rates could come down. And then Credit Suisse collapsed, and then it was bought by UBS for under market value, and a deal arranged by the Swiss government and UBS. And then swap rates started going up again, and then the Fed increased their rate. So so I wrote one story the week before, and then another story saying almost completely the opposite thing a week later. So I think that I suppose that just kind of shows how quickly things can change. But I think the most recent one I wrote was just saying, the UK banking system is safe. It's more, we've got better capital and liquidity, more protections in place after following the global financial crisis. But it might just make mortgage lenders a bit more cautious. It might, have a knock-on effect, like a ripple effect, in the sense it might make banks a bit more cautious. But again, it's so hard to say, because then you have the other side of it where lenders might have to get more competitive, and then they might cut rates. So then it's really, really difficult to kind of see the kind of butterfly effect of it.
Richard, you're nodding away there. Anything to what Martin said?
I think for me, I totally agree with Anna. The pace at which things can escalate. We operate in a Twitter-oriented world now, where that news can spread like wildfire. And I forget the figures on how much got withdrawn from Silicon Valley Bank sort of overnight, but it made Northern Rock look look fairly calm with all those queues that we saw back in the 2000s. I think the other point that it really highlights is, and I am not an expert on this stuff in the slightest, but from what I've read, is a lot of this happened because of the change to the levels of regulation that Trump brought in 2018. And so for me, what it highlights is the importance of regulation. And I think where we are lucky in this country is we've got consumer duty coming in at the moment, and I'm sure everybody is fed up to the back teeth of talking about it. But regulation in our market is a good thing. It protects banks, it protects intermediaries, and it protects consumers.
I think I'm going to come to you, Phil, but I think I'm going to probably say a little bit what you're going to say. But what worries me is this government's need or want or drive for less regulation panics me, because actually I agree with you, Richard, 100%. The regulation is what we need. And Phil, I'm presuming you're on the same mindset as me.
Yeah, no, yeah. I mean, I was worried a few weeks ago. That there were a lot of were we seeing parallels to 2008 when it all sort of kicked off? And had a conversation with our CEO, and he was really good at spelling out the differences between now and 2008. So this was more interest rate risk, while 2008 was credit risk. And we are, certainly in the UK, we appear to be much better capitalised, as Richard said, due to good regulation. Now, what seems to have happened in the US was the Trump administration unravelled some of the tightening up post 2008, and no stuck Sherlock. What happened? Yeah. So hopefully that's where some of the parallels have ended. But it's all back to confidence as well. As long as confidence in the banking sector is there, then hopefully we won't see a return to sort of Northern Rock circumstances, and that's what we want to avoid.
Tony, that's what consumers are going to see, though, isn't it? They're going to remember Northern Rock, and I know a lot of people don't understand the depths of what we're talking about here, and the general consumer is going to be a little bit like just seeing the news and going, "Oh, here we go again." So I think there is an element of it being inflamed, as Richard said. I quite like what you said there about living in the Twitterverse of news, which is like everything spreads so quickly. So Tony, it's a consumer confidence side as well, isn't it? There's that confidence, and we're not going to go back to where we were.
Yeah, look, exactly, and the very nature of the fact that these got stopped and picked up means that we have learned the lessons. All right, maybe not as quickly as we like in the States with that, but as Phil said, I think that would not happen in the UK again, in my personal view, in terms of the amount of scrutiny and the amount of involvement with particularly the prudential regulator, in terms of all banks and bill size, etc. So yeah, I don't think it will. So but it's incumbent on us as the banks and building societies to educate the consumer. So when all this hit, I asked Marcus to our marketing head of marketing to prepare a statement to make sure that everybody understood that, you know, this is not a problem for us, because at the same time as this happened, we withdrew a number of products, and that wasn't through any commercial or funding concern. It was we were too busy, and therefore we were taking the gas off for a bit. But you know, you don't want people putting 2 and 2 together and adding up to 5. So it's about creating that comfort at the point of when it happens. I think that's the key thing to do, is educate. I know we've used it a lot. It's easy to say and not as easy to do, but that is the key of keeping people just calm in the right places.
There's a really good article in the Times that Nick Mendes from John Charcoal shared with me. It quite alarmed me how to prepare for a credit crunch, but actually it's a really balanced article. I thought it was quite good.
Well, on that very deep topic, that's our time up. I just want to that was so enjoyable, and those sorts of conversations are conversations that could go on forever. I think looking at the panel, I think everybody's ready for another hour, but we've run out of time. So just want to go around the room, just say thank you to everyone. Richard, thank you for first time round with us. Hope you'll come back.
Thank you for having me. I will be delighted to come back. Really enjoyed it.
We would love to have you back. We'll book you in the later months. Anna, welcome back, and thank you again for joining us.
Absolutely.
And
Pleasure.
Phil and Tony again, welcome. Oh, thank you. And Tony, thanks for eventually getting to us and driving safely for the benefit of the rest of the road users. So thank you.
For being late, yes.
Yeah, if anyone doesn't remember, this is the day of the storm coming in from France, and Tony got the full brunt of it today. So that's it from us for this month. Don't forget SFI Live. If you're a viewer and you're a broker, SFI Live is coming up at the beginning of April. So do give us a watch if you can. Look out and register as soon as you can. But from us for this month, for April, that's it. It's goodbye, and we look forward to seeing you next month. Take care.